Here's a number nobody talks about. $10,000 invested in the S&P 500 10 years ago is now worth over $33,000. Same $10,000 in a savings account? Worth about $10,400. That's a $23,000 difference for doing absolutely nothing different. The only difference, one person invested. The other didn't. And here's what makes it worse. Most people think investing is complicated. They think you need to be rich. They think you need to be a genius. None of that is true. By the end of this video, you'll know exactly how to start investing, exactly what to buy, and exactly how to avoid the mistakes that cost beginners thousands of dollars. Let's go. Welcome back to Money Made Simple, where we break down US money topics in plain English. No jargon, no fluff, just what actually matters. Hit subscribe if you're new. Let's go. Here's the thing. Investing is the single most reliable way to build wealth in America. Not crypto, not real estate flipping, not day trading. Boring, slow, consistent stock market investing. And yet nearly half of Americans don't own a single stock. Not one. Why? Because the financial industry made investing feel like it's only for people in suits on Wall Street. They use words like diversification and expense ratios and asset allocation to make you feel like you need them. You don't. You need about 15 minutes and a phone. This is your complete beginner's guide to investing in the stock market in 2026. What it is, how it works, what to buy, what to avoid, and the exact steps to start even if you only have $50. So what actually is the stock market? Think of it like a store. But instead of buying groceries, you're buying tiny pieces of real companies. Apple, Microsoft, Amazon, Google. When you buy a stock, you're buying a small ownership slice of that company. That slice is called a share. Here's why that matters. When the company grows, your slice grows. When the company makes money, you make money. You don't have to do anything. The company does the work. You just own a piece of it. Simple example. You buy one share of Apple at $150. Apple keeps selling iPhones, making money, growing. A year later, that share is worth $180. You made $30. Not because you did anything, because Apple did. That's it. That's the stock market in plain English. Now here's how it actually works behind the scenes. There are major exchanges, the New York Stock Exchange and the NASDAQ. These are giant digital marketplaces where buyers and sellers meet. You don't go there yourself. You use a brokerage and app that places the trades for you. Fidelity, Vanguard, Charles Schwab, Robinhood. When you buy a stock, you open the app. You place an order. The app finds a seller. The trade executes. You now own shares. The whole thing takes about 3 seconds. Now stock prices move every second of every trading day. Why? Simple. Supply and demand. More people want to buy, price goes up. More people want to sell, price goes down. That's it. Not magic. Not manipulation. Just buyers and sellers. But here's what most beginners get wrong. They see a price drop and they panic. They think it's crashing. I need to sell. The stock market goes up and down every single day. That is not a problem. That is a feature. The S&P 500, the 500 biggest companies in America, has averaged about 10% annual returns over the last 50 years. Some years up 20%, some years down 15%. But over time, it always climbs. Now what should you actually buy? This is where most beginners freeze. There are thousands of stocks. Which ones do you buy? How do you know if you're picking the right one? Here's the truth. Most people should not be picking individual stocks. You know why? Studies show that over a 15-year period, 90% of professional fund managers fail to beat the market average. 90%. These are people whose entire job is picking stocks. With Wall Street offices, with teams of analysts. They can't do it. So you checking stocks on your phone during lunch, that is not a strategy. That is gambling. Here's what actually works, and it's embarrassingly simple. An index fund, specifically an S&P 500 index fund. When you buy one share of an S&P 500 index fund, you instantly own a tiny piece of 500 companies. Apple, Microsoft, Amazon, Google, Johnson & Johnson. All 500 in one single purchase. You are not betting on one company. You are betting on America. And over the long run, America's biggest companies have consistently grown. The two best options for beginners: Vanguard's VU and Fidelity's FIXX. Both track the S&P 500. Both charge about 0.03% in fees. That is 30 cents per year on every $1,000 invested. Now there's one thing you need to watch out for. It's called the expense ratio. That's the fee the fund charges you every year. Some funds charge 1% or more. That sounds small, but on a $100,000 portfolio, that's $1,000 per year in fees. Over 30 years, that single percentage point can cost you over $100,000 in lost growth. VU, FXX, 0.03%. That's your answer. Now here's the part most beginner videos completely skip. The 3 mistakes that kill more investors than any market crash ever has. Stay with me because avoiding these 3 things is worth more than any stock tip you'll ever hear. Mistake number 1. Day trading. This is where people try to buy and sell stocks within the same day, hoping to profit from tiny price movements. It sounds exciting. It looks exciting on social media. Here's the reality. Studies show that about 80% of day traders lose money. Not some. Not half. 80%. You are not a hedge fund. You are not an algorithm. Don't day trade. Mistake number 2. Panic selling. The market drops 10%. The news says crash. Everyone around you is selling. And you sell too. Here's what that costs. If you missed just the 10 best days in the stock market between 1993 and 2023, just 10 days out of 10,000, your returns dropped from 9.8% per year to 5.5% per year. Missing 10 days out of 10,000 cost you almost half your total wealth. The market will drop. It always does. In 2008, it dropped 50%. In 2020, it dropped 34% in 30 days. In 2022, it dropped 20%. Every single time it came back. Every single time it hit new highs. The investors who got rich were not the ones who predicted the crash. They were the ones who kept buying during it. Mistake number 3. Putting everything in one stock. Remember Enron? One of the biggest companies in America. Thousands of people had their entire retirement savings in Enron stock. The company went bankrupt overnight. Those people lost everything. That is exactly why index funds exist. You spread your money across 500 companies. No single company can take you down. Now, what if the market crashes right after you invest? This is the number 1 fear every beginner has. And it's a fair question. Here's the honest answer. It might. Markets crash. They always have. 2001, 2008, 2020, 2022, crashes are a completely normal part of investing. But here's what most people don't understand. A crash is only a loss if you sell. If you hold and you keep buying while prices are down, you are getting stocks on discount. Think about it. If you buy a pair of shoes for $100 and the next day they go on sale for $80, you don't panic. You don't return your shoes. If anything, you buy another pair. The stock market works exactly the same way. Real example. In March 2020, the S&P 500 dropped 34% in just 23 days. People panicked. They sold everything. But by August, just 5 months later, the market had fully recovered. The people who held or kept buying made more money, not less. Don't fear crashes. Prepare for them. Keep buying. Keep holding. Let time do the work. Now I'm going to show you the exact step-by-step to start today. Even if you only have $50. Even if you've never opened a brokerage account in your life. This is the part that actually matters. Keep watching. Here are your exact 5 steps to start investing today. Step 1. Open a brokerage account. Go to fidelity.com. It's free to open. No account minimum. No hidden fees. You can buy fractional shares, meaning you can invest $5 in any stock or fund. It takes about 10 minutes. You'll need your ID, your social security number, and your bank information. Step 2. Choose a Roth IRA. This is the most important account decision you will ever make. A Roth IRA lets you invest money you've already paid taxes on. It grows inside the account, and when you take it out at retirement, you pay zero taxes. Not low taxes, not deferred taxes. Zero. Here's the math. $500 a month from age 25 to 65 at 10% average return inside a Roth IRA gives you $2.8 million. All of it tax-free. The same money in a regular account, you'd lose $400,000 to $500,000 in taxes on the way out. Same money, same investments, different account. $500,000 difference. Open the Roth IRA. You can contribute up to $7,000 per year in 2026. That's $583 a month. If you're over 50, $8,000 per year. Step 3. Transfer money in. Start with whatever you can afford. $50, $100, $500. It doesn't matter. What matters is that you start. Set up automatic monthly deposits. Same amount. Every month. Without thinking about it. This is called dollar cost averaging. When prices are high, you buy less. When prices are low, you buy more. Over time, it smooths out the risk automatically. Step 4. Buy VU or FXX. Search for VU or FXX inside your Fidelity account. Both track the S&P 500. Both charge almost nothing in fees. Enter the amount you want to invest. Click Buy. You are now an investor. Step 5. Do nothing. This is the hardest step. Don't check it every day. Don't panic when it drops. Don't sell when you see red numbers. Just keep adding money every single month. And let the market do what it has done for over 100 years. Climb. Quick recap. Open a free Roth IRA at Fidelity. Set up automatic monthly contributions, even $50. Buy VU or FXX, the S&P 500 index fund. Do not day trade. Do not panic sell. Do not put everything in one stock. And when the market crashes, keep buying. That is the entire strategy. The stock market is not complicated. It has just been made to feel complicated. The only thing standing between you and $2.8 million is starting. Today is your day 1. Now I want to hear from you in the comments. If you could only invest $1 in the stock market today, what would you buy? Drop your honest answer below. I read every single one. And if this video finally made investing make sense, hit that subscribe button so you never miss another money breakdown like this. Check out the video on screen for more ways to build real wealth. See you in the next one. This video is for educational purposes only and is not financial advice. Always consult a licensed professional for your specific situation.